Well, this month's note on Alpha Strategist, the note that is meticulously prepared by the team at Motilal Oswal, is um, optimism and arithmetic. And they quote Ben Graham when they say, buy not on optimism but on arithmetic. Now, it'd be lovely to get in Ashish and Nitin. Now they need no introduction because we talk to them every single month. I mean, they don't need introduction on this platform. They anyways don't need an introduction. But it's great to talk to them today about what is it that they are trying to convey when they are talking about arithmetic. Now, gentlemen, I would believe that when a note says that, or when a note quotes right at the front that buy not on optimism but on arithmetic, it is sounding cautious. Am I reading it right or am I reading it wrong?
Yeah, so Niraj, thank you for having us again this month. And as I normally say that it's every edition is a continuation of what we've been messaging through the year. And if you recollect our conversation last few months, we've been quite optimistic, and especially on equities. And a lot of the markets have kind of played out closer to what we expected. I mean, you've seen huge FII flows, which is driving markets, and there is a lot of momentum. Having said that, if you see, we have a temperature gauge that we publish every month, which basically is a word on valuations. Now, if I look at the temperature gauge right now on the large cap, it is still in fair value zone, inching up towards the expensive zone. However, what has moved up very sharply is the small and mid cap space, and we continue to be very optimistic about the future. The next 3-5 years look good, and a lot of the drivers are in place. This is more a messaging of how people should build their portfolios. So we believe that given where valuations are, some bit of the optimism may be front-ended, especially in the small and mid-cap space, and hence the messaging that any incremental allocation in equities could happen in a slightly staggered manner, especially in the small and mid-cap space. And we are saying that any additional exposure that investors may need to take should be taken more towards large cap, or rather multi-cap kind of strategies. So that's the messaging, Neeraj. I mean, I just wanted to ensure that the longer term outlook continues to remain positive, but the near term markets have run up. Of course, earnings have also been decent, but it's just that taking a cue from the subject of the note, when you invest, you cannot just invest on sentiment or optimism. You have to look at the underlying maths, the EPS growth, the earnings have to keep pace. Otherwise, something will give way at some point.
So did earnings disappoint you? Also, I asked this question specifically, Ashish, because relative to what was the market level the last time that we spoke, we are about a couple of percentage points lower on the Nifty. So if at all the markets haven't gotten more expensive, relatively speaking, they would have gotten more cheap. And yet I'm hearing you sounding a bit more cautious than what you were the last time. Why this change?
Yeah, you want to comment on earnings, Nitin?
So earnings, I mean, we are still yet to fully complete the quarter. But from whatever we've seen so far, most companies have either been at par or slightly higher than whatever was estimated in terms of earnings growth. The only disappointment, if at all, at the margin would be IT. Otherwise, the pack is definitely led by BFSI, both banks as well as NBFCs. And clearly, this is a reflection of the fact that over the last 5 years, you've seen such a surge in terms of advances, such a cleanup in terms of bank balance sheets, especially NPAs, so on and so forth. They are at decadal lows as we speak. Importantly, India Inc. has deleveraged significantly over these last few years. And hence, a lot of banks today are well capitalized and well primed, I would say, to fund the next leg of capacity expansion as and when it actually happens. So do not see disappointments per se, but we'll have to wait and monitor how things really progress from here. At this point of time, the key sectors that are driving the earnings growth is obviously BFSI, auto, and at the margin a little bit of metals, but that's more cyclical in nature. Consumers will come in. The sentiment so far has been rather good judging by the sales that have taken past in the last quarter or so. So we hope that the momentum of earnings really continues going forward.
So to your point, Neeraj, actually Nifty is not that much of a concern, to be honest. I mean, the change in the valuation, even if you look at a temperature gauge, is really marginal. And temperature gauge also captures interest rates. So if interest rates tend to inch up, then the valuations become a little more expensive and vice versa. So the Nifty, we haven't really seen too much movement, but it's basically the broader market which is moved up, and that is where we believe that one should build portfolios, with a little bit of caution and gradually.
Got your point. So Nitin and Ashish both, the last 2 odd weeks, I've heard a bunch of tactical strategists come and talk about how some of the pockets have run up a lot more. And while there has been strong earnings performance, the run up has been very strong. Maybe a kind of going on the lines of what you are saying as well when it comes to the broader end of the spectrum. And therefore, sometime in this conversation, I would love to talk about, if you can, some of these pockets as well, wherein you've observed a mismatch there. But before that, the point, since you mentioned that the Nifty is okay, I would want to draw a point that you guys had made the last conversation, wherein you had said that if we correlate the index levels to what has happened in the past, then we should ideally be at much higher levels than what we are currently. Now, I'm hearing you say again today that the Nifty is not a problem, but we're seeing a bit of a pullback in the Nifty last 10, 15, 20 days, maybe because of the FI liquidity withdrawal. You guys speak to a lot of HNIs and institutions locally, maybe even globally. What's the sense that you get? Is there a possibility that the pullback of liquidity globally might continue further? And could that hurt our markets?
Yeah, so I think if you have to look at the FI liquidity in the context of what has also happened in the previous 18 months, and FIs have been, in a sense, short on India because you had seen a lot of selling happening right up to March, April this year. And a lot of the flows which have come in is more catch up, because if you look at the other emerging markets and you compare India, I think India still continues to be in a very, very strong spot. Compared to, let's say, even a China or even some of the globally developed markets. So a lot of the flows have been literally playing catch up. Now the challenge is, Neeraj, if you actually look at what's happening in the US, inflation continues to be reasonably sticky, right? We've seen continuously higher prints on inflation, and globally actually there is a withdrawal of liquidity, right? Typically, when there is a withdrawal of liquidity, you tend to have some impact in terms of allocations. Although the India flows have still been reasonably resilient, but my experience is that something normally gives way when globally liquidity is reducing. I mean, markets beyond a point cannot move up just on optimism, like we mentioned. There needs to be liquidity, and there needs to be concrete catalysts in the near term for the markets to continue their journey. So that's really that is another thing that is currently playing on our mind. I mean, Nitin, if you want to add anything to what I'm saying.
No, absolutely. I think the correlation has worked for a long period of time. We are seeing some breakdown of that correlation in this year, especially. So that's a key monitorable for us. At what point of time do equity markets really converge to whatever's happening in terms of system liquidity, especially with all the G4 central banks, pulling back. So apart from that, though, I think India continues to remain.
Yeah, and just wanted to come in on your point on HNIs, Neeraj. You had asked how is the sentiment and how are they behaving. See, like we spoke earlier, also a lot of money this year has gone into structured debt because the interest rates have been high, and the yields have been pretty attractive. So really, this rally has taken some of the large investors or HNIs by a little bit of surprise, because most people hadn't allocated. So there is a little bit of wait and watch, which is happening currently. It's not that we are seeing. I mean, of course, the SIP flows continue. That's the structural story. But when it comes to lumpy flows, still people are a bit sanguine. So I suspect that if markets do correct, it will be healthy, and you might see a lot of HNI liquidity also coming in. So at best, Neeraj, what I see is there could be a kind of a range bound scenario, because I don't expect. I mean, although valuations have moved up a bit, I don't expect the markets to crack really, because the broader macro picture, and it'll be healthy if markets kind of spend time here.
Yeah, just wondering. So you reckon that the HNI flows into the markets might come in after a corrective move, or is this move letting people start thinking about putting money which was not in the markets to come into the market? Because we know money is coming in from the MF route for sure. What we never have a color of is the HNI color, HNI community, which you guys have a color about. Tell us a bit about it.
Yes. So, like I mentioned, the flows into equities this year have been much lower than some of the other alternative asset classes that we've seen. So this move up, whenever there is a sharp move up, we normally see a little bit of a tempering of flows, because everybody wants to get in at the right time. So I do believe that right now portfolios are in a bit of a wait and watch mode, and if the markets do crack from here, let's say 5%, 10%, then we will see a gush of liquidity coming in, because I don't see a challenge with liquidity, to be honest. When I speak to our investors, when I speak to family offices, when I speak to HNIs, and typically these kind of markets also, what they do is they create more liquidity from a wealth point of view. I mean, if you see, suddenly you've seen a lot of IPOs hitting the market. Suddenly we are seeing a lot of stake sales going through. We are also seeing liquidity through PE investments coming through. So whenever there are two sides to the coin. I mean, markets have moved up, and that also means liquidity creation in the hands of HNIs.
Got it. Yeah. So I was just wanting to know whether they are already thinking of it, or will it happen maybe 4 or 5% lower. So I got that answer. Thanks for that. Now, Nitin, to you, in one of the slides, you guys have spoken about how that when you look at the top 500 companies ex financials, forget the PE, but the cash flow from operations has steadily improved. And I think in one of the statements you mentioned that if this continues, then it actually means there's a scope for re-rating. Now, please tell us that how does this arithmetic play out, assuming that the improving trend continues? Does this have the scope of surprising the markets on the upside over a 3-4 year period?
Sure. So this analysis that you're referring to, Niraj, really takes into account the top 500 companies ex of financials, right? Now, if you look at peak-to-peak performance, which is, let's say, October 2021, and where the markets are today, obviously the markets have gone up. Nifty may be up about 10-odd%. Mid and small caps would be up anywhere between 12 to 15%. But the cash flow from operations has risen by a far larger magnitude, which is why the EV by CFO, which is enterprise value by CFO, has pretty much remained at the same levels from the earlier peak. Also, one more point to note here is that cost of capital, if you measure it by the 10-year GSEC, has gone up during this time period by almost 100 bips, right? It was 6.2% then. It's almost close to 7.1, 7.2%, around about that range. Now, based on whatever the RBI has mentioned in its last policy, we may be in for a prolonged pause. But at some stage over the next 2 to 3 years, we are definitely likely to see interest rate trends moving lower. Obviously, what that means is that cost of capital is likely to get cheaper over the coming years, which means this particular ratio definitely has a scope for re-rating. What is also healthy to see is that this is not just consolidated within a small group of companies. It is much, much more broad-based. So to answer your question, I think earnings growth definitely is the key fundamental reason for the driver of stock prices going forward. And we believe that this trend is likely to stay over the next.
I mean, just to make it simple, Neeraj, for your viewers, essentially what we are saying is the quality of earnings is much better today. So at the same EPS, the companies are generating that EPS into cash flows much faster.
Got it. Thanks for that, both of you. Now, final set of questions. We've discussed equities. You've spoken about how at a corrective move, it might be better because the arithmetic still is in favor, right? I presume that the numbers still point towards a 1 year probability of the markets being higher than where they are right now. Is that a fair assumption? It is.
Absolutely.
Okay.
I mean, I would go with that assumption. It's just the near term that is looking a bit challenging. That's it.
Got it. So that's equity. What about, we haven't, the last 2 or 3 conversations, I haven't been able to ask you anything on fixed income, gold, which is what we started off with at some point of time in March, but we spoke about all the asset classes. Any changes, any major changes to the fixed income or the gold outlook, gentlemen?
Yeah. Please.
So nothing changes much. I think what the RBI has also pointed out is, to a slight blip in terms of inflation, right? The earlier inflation projections have just been taken up upwards. So we'll have to wait and see whether there is at max one more rate hike that may come up in October. But to our minds, we are likely to see, like I mentioned earlier, a prolonged pause, and interest rates are likely to remain higher for a longer period of time. Also, this recent introduction of the interim CRR is to take out about 1 lakh crore of liquidity from the system. The system overall liquidity is about 2.5 lakh crores as we speak. So what that will ensure is that, at the shorter end of the curve is likely to be at par with the current repo rate, which is at 6.5%. The curve is absolutely flat as we see it, right? But the sweet spot remains between the 3 to 7 year segment in terms of accrual. So from an incremental fixed income perspective, obviously tax notwithstanding, we believe that that's the space for AAA or GSEC. GSEC is obviously the best way to play it because there is hardly any spread, any corporate spread to talk about. So investors should look at that segment from a roll down strategy perspective. Also, the equity savings funds, which allow a multi-asset play to investing into fixed income solutions. Apart from that, we do see a lot of interest given the higher yields in private credit strategies. Strategies which offer special situations, but more from a fixed income perspective, whether it be in select plays of real estate or even the infra oriented strategies. And also you can partake into some of these listed instruments like REITs as well as InvITs. So there is a whole bouquet of fixed income solutions out there for investors to partake in. Gold should be played more as a hedge in the portfolio to risk off against volatility, extreme volatility that can be caused through risk assets. So that's the way we put in the entire asset allocation for clients.
And our view on gold remains positive, because if you see central banks continue to buy gold, and I think there is something somewhere, even countries are trying to hedge their own reserves against the dollar. On the fixed income front, I know that the recent inflation print came in a little higher than expectation. But however, if you actually analyze it, a lot of it is food inflation. The core inflation still is under control. So we are hoping that, once this season is through, hopefully these prices should cool off.
Okay. And viewers, if you are convinced, or if you're wanting to know more about some of these assets that Nitin spoke about, BQ Ram has just launched a series called The Alternative Bet, wherein we talk about both private credit and infra options in that series. So do try and have a look at those shows. Nitin, Ashish, thank you so much, gentlemen, for taking the time out and giving us your wisdom and talking about this report. Much appreciated.
Thank you, Niraj.
Thank you. Thank you so much.
And viewers, thanks for tuning into yet another conversation on the report Alpha Strategist by Motilal Oswal.